Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. The word extremely in the title is a kind of pun, because the stories represent extremes of various sorts that were manifest on Wall Street in recent years. They hold instruction and grave warnings for everyone who has a serious connection with the world of stocks and bonds, not only for ordinary investors and speculators but for professionals, security analysts, fund managers, trust account administrators, and even for bankers who lend money to corporations. The 4 companies to be reviewed, and the different extremes that they illustrate are: Penn Central Railroad Company. An extreme example of the neglect of the most elementary warning signals of financial weakness, by all those who had bonds or shares of this system under their supervision. A crazily high market price for the stock of a tottering giant. Ling Temco Vought Incorporated. An extreme example of quick and unsound empire building, with ultimate collapse practically guaranteed, but helped by indiscriminate bank lending. NVF Corporation. An extreme example of one corporate acquisition, in which a small company absorbed another 7 times its size, incurring a huge debt and employing some startling accounting devices. AAA Enterprises. An extreme example of public stock financing of a small company, its value based on the magic word franchising, and little else, sponsored by important stock exchange houses. Bankruptcy followed within 2 years of the stock sale and the doubling of the initial inflated price in the heedless stock market. Ling Temco Vought Incorporated. This is a story of head-over-heels expansion and head-over-heels debt, ending up in terrific losses and a host of financial problems. As usually happens in such cases, a fair-haired boy, or young genius, was chiefly responsible for both the creation of the great empire and its ignominious downfall, but there is plenty of blame to be accorded others as well. The rise and fall of Ling Temco Vought can be summarized by setting forth condensed income accounts and balance sheet items for 5 years between 1958 and 1970. The first column shows the company's modest beginnings in 1958, when its sales were only $7 million. The next gives figures for 1960. The enterprise had grown 20-fold in only 2 years, but it was still comparatively small. Then came the heyday years to 1967 and 1968, in which sales again grew 20-fold to $2.8 billion, with the debt figure expanding from $44 million to an awesome $1,653 million. In 1969 came new acquisitions, a further huge increase in debt, to a total of $1,865 million. And the beginning of serious trouble. A large loss, after extraordinary items, was reported for the year. The stock price declined from its 1967 high of $16912 to a low of $24. The young genius was superseded as the head of the company. The 1970 results were even more dreadful. The enterprise reported a final net loss of close to $70 million. The stock fell away to a low price of $718. And its largest bond issue was quoted at one time at a pitiable 15 cents on the dollar. The company's expansion policy was sharply reversed, various of its important interests were placed on the market, and some headway was made in reducing its mountainous obligations. The figures in our table speak so eloquently that few comments are called for. But here are some. 1. The company's expansion period was not without an interruption. In 1961 it showed a small operating deficit, but, adopting a practice that was to be seen later in so many reports for 1970, evidently decided to throw all possible charges and reserves into the one bad year. These amounted to around $13 million, which was more than the combined net profits of the preceding 3 years. It was now ready to show record earnings in 1962, etc. 2. At the end of 1966, the net tangible assets are given as $7.66 per share of common, adjusted for a 3-for-2 split. Thus the market price in 1967 reached 22 times its reported asset value at the time. At the end of 1968, the balance sheet showed $286 million available for 3,800,000 shares of common and Class AA stock, or about $77 per share. But if we deduct the preferred stock at full value and exclude the goodwill items and the huge bond discount asset, there would remain $13 million for the common, a mere $3 per share. This tangible equity was wiped out by the losses of the following years. 3. Toward the end of 1967, two of our best-regarded banking firms offered 600,000 shares of Ling Temco Vought stock at $111 per share. It had been as high as $16912. In less than 3 years the price fell to $7184. At the end of 1967 the bank loans had reached $161 million, and a year later they stood at $414 million, which should have been a frightening figure. In addition, the long-term debt amounted to $1,237 million. By 1969 combined debt reached a total of $1,869 million. This may have been the largest combined debt figure of any industrial company anywhere and at any time, with the single exception of the impregnable Standard Oil of NJ. 5. The losses in 1969 and 1970 far exceeded the total profits since the formation of the company. Moral: the primary question raised in our mind by the Ling Temco Vought story is how the commercial bankers could have been persuaded to lend the company such huge amounts of money during its expansion period. In 1966 and earlier, the company's coverage of interest charges did not meet conservative standards, and the same was true of the ratio of current assets to current liabilities and of stock equity to total debt. But in the next 2 years the banks advanced the enterprise nearly $400 million additional for further diversification. This was not good business for them, and it was worse in its implications for the company's shareholders. If the Ling Temco Vought case will serve to keep commercial banks from aiding and abetting unsound expansions of this type in the future, some good may come of it at last.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye bye.